Understanding the P/E ratio, a key to valuing stocks. Is a stock overpriced or a hidden gem? The P/E ratio can tell you. What is the P/E ratio? The price to earnings P/E ratio is one of the most widely used metrics in fundamental analysis. It helps investors understand how much they are paying for every 1 Indian rupee of a company's earnings. Formula: P/E ratio equals market price per share divided by earnings per share, EPS. For example, if a company's share price is 100 Indian rupees and its EPS is 10 Indian rupees, P/E ratio equals 100 Indian rupees / 10 Indian rupees equals 10. This means investors are willing to pay 10 Indian rupees for every 1 Indian rupee of earnings the company generates annually. Why is the P/E ratio important? The P/E ratio helps you compare valuation between companies. Judge if a stock is overvalued, undervalued, or fairly valued. Make informed investment decisions. It's like asking, how many years will it take for me to earn back my investment if the company's earnings stay the same? Types of P/E ratios. Trailing P/E. Uses past 12 months' earnings, most common. Reflects actual performance. Example: if TTM EPS equals 20 Indian rupees and stock price equals 200 Indian rupees, P/E equals 10. Forward P/E. Uses estimated future earnings. Helps in predicting future value. More speculative, but useful for fast-growing companies. How to interpret the P/E ratio. P/E ratio meaning low P/E, e.g., less than 10. Stock may be undervalued or facing poor prospects. Average P/E, 10 to 25, generally fairly valued, depending on industry. High P/E, 25 plus, may be overvalued or have high growth expectations. Important: a high or low P/E doesn't tell the full story. Context matters. Example: comparing two companies. Let's say you're comparing Company A and Company B. Metric: Company A, Company B. Share price 500 Indian rupees, 1000 Indian rupees. EPS 25 Indian rupees, 20 Indian rupees. P/E ratio 2050. Company A, lower P/E equals might be undervalued or mature. Company B, higher P/E equals might have strong growth ahead but priced expensively. Question to ask: is Company B really worth paying 2.5x more than Company A for the same 1 Indian rupee of earnings? When to use the P/E ratio. Use it when the company is profitable. You want to compare similar companies in the same sector. You're screening for value stocks or growth stocks. Avoid using it when the company has negative earnings. P/E is meaningless. Comparing companies across very different industries. In volatile market conditions where EPS fluctuates drastically. Industry benchmarking. Always compare a company's P/E with its historical average, its industry average, its competitors' P/E ratios. For example, a tech company with a P/E of 35 may be reasonable if the sector average is 40. But a PSU bank with a P/E of 35 might be overpriced if the sector average is 10. Limitations of the P/E ratio. Doesn't factor growth rate. Use PEG ratio for that. Can be distorted by one-time earnings or losses. Not useful for companies with negative earnings like startups. Market sentiment can inflate or deflate P/E irrationally. Pro tip: combine with other metrics to get a more complete picture. Use PEG ratio, P/E divided by growth rate. Look at debt levels, ROE, and cash flows. Read management commentary and future plans. Final thoughts. The P/E ratio is a powerful tool, but only when used wisely and in context. It's not about finding the lowest P/E stock, but finding quality companies at reasonable valuations. As Warren Buffett said, price is what you pay. Value is what you get. Let the P/E ratio help you pay the right price.